Fund Supermart, your online gateway to unit trusts.
What is your outlook for global equities in 2016?
For global equities in 2016, we are quite optimistic. We're very positive for 2016 for global equities. Particularly when we look at the valuations, it's quite attractive compared to the year before, and it's trading in quite a fair value, especially for developed markets. For global equities in general, if you look at developed markets, emerging markets, of course, there are how do you actually strategically position your portfolio, for 2016. Particularly, we like the developed market. It's still intact. The fundamentals are very strong. The US are in recovery. Europe continue to recover. So these are the opportunities we think, for investors to accumulate now, given the current valuation. And but broadly, if you look at emerging markets, whether it's Asia Pac, whether it's Asian, ASEAN, the valuation also has become attractive in the last 2 months. So broadly, global equities, for us, we're very positive in it, and we do encourage investors to sort of diversify into global equities, not really be so defensive.
What are the key risks that investors should be aware of? How is your strategy positioned to mitigate this risk?
I guess for the investors, the risk, the way we see it, if you're Malaysian investors, obviously if you are diversifying your portfolio and you have exposure to foreign portfolios, one of the risks is of course currency, and most of the portfolios are in dollar. That is something that you need to look at in the direction of dollar versus ringgit. Last year, of course, dollar strengthened against ringgit, and now year to date you look at ringgit strengthening against US dollar. But whether it's something whether it's a permanent, whether it's a short term, well, that's pretty much depending on the macro environment. Obviously, one of the things that affecting the ringgit is of course the oil price, and also the policy direction of the US, whether they're going to increase interest rate or not. In terms of our strategy mitigating this risk, for us, fundamentally, the portfolio, it's the assets that we put together in our portfolio. That's really important. Over time, that will surpass that that currency risk, because currency is just more of a passing through. But what's important is the kind of assets that we have in our portfolio. So for us, our portfolio is constructed. It's bottom up, stock picking, and for our global equity, we our portfolio is quant based. And the thing is how we mitigate the risk. Of course, we look at financial risk of each of the stocks, in our portfolio. The other part of it, we also look at non-financial things like ESG. That's something new. So we combine both financial and non-financial to find the right stocks. Financially, there are stocks probably looks great, but in the long term, what we based on our research, if they don't have proper governance, like even things like composition of the board, who actually sit in the board, and then also in terms of their policy on environment, policy on social, that have a long-term effect, especially those very big corporations and big companies. We have seen what happened with ExxonMobil, we have seen what happened with Toshiba. This is large corporations. That things that pull them down is the part on the non-financial. So our global equity portfolio, our bottom-up stock selection, we look at both. And another thing is also in terms of our cash allocation. We're very active on the cash allocation because it's done on a daily basis. How we respond to the volatility of the market. So this portfolio we're able to actually cash out quite immediately. Yeah? I mean, actually on a daily basis, because currently, if you look at given the increased volatility in the global market, we're about 40% in cash. Yeah, compared to before. Yeah, we were about 20% in December, and now we're at 40%. So in a very short period of time. I mean, that also a reflection of how the market was very, the risk sort of increased just in 34 months.
Our research team has recently upgraded the star ratings for the US to 2.5 stars and Europe to 3 stars. Do you find the US and Europe markets attractive?
Yes, we do. We find US and Europe attractive, at least in the last 2 years. The recovery of the US and the Europe we start seeing in the last 3 years, 3-4 years ago. So we are optimistic with US and Europe. They are on the road of recovery, and the fact that the Federal Reserve increased 25 basis points last year, I mean that is a good indication of the strengthening of the economy, and they're still planned to increase the rates. And I guess probably what's holding them back at the moment is because they want to see how the other market is also doing, because the US market and the Europe market also they also have dependencies on other markets, especially the emerging markets, in particular will be China, India, So I think everybody is looking at particularly in China, whether it's going to stable soon, and whether the policies introduced by the government will take into a positive effect. But overall, fundamentally, the US and Europe does great, and we are certainly a strong proponent of US and Europe, and our global equity fund is also well positioned in those markets.
Okay. So any sectors in particular within US Europe that you like?
For the sectors, we still look at consumers, retail trades, we look at technologies, healthcare, these are some of the top sectors.
How have global emerging markets performed last year, and what is your expectation for this region in 2016?
I think if you look at what happened last year, I mean, obviously, emerging markets got hit really bad, because of the falling of the commodity prices, I mean, currently you're also seeing the central banks, some of the markets are, acting their rates, to spur growth for the economies. For us, we still see risk in emerging markets. I mean, for this year, 2016, particularly because commodity prices still, have not really moved much. It's still at risk. And but the thing is, because some of the emerging markets, they are net importer of oil. So they probably benefit from the current oil price level. So over time, they may, get out from the current situation. But for a long-term sort of strategic investment, I mean, obviously, emerging markets, this is where the growth is in the long term, because of the increase of the middle class, and there's a still strong demand, particularly in China and India, South America, and ASEAN. So tactically, maybe for the short term, may not something that we favor, but obviously the long-term story for emerging markets is still intact.
How should investors position their portfolio in 2016?
I guess for 2016, given that we didn't start the year, with a bang, well, a different kind of bang, and it's an opportunity to accumulate actually. If you look at the valuations, it's not that low, it's still around the fair value. I think it's about 13, 14 times.
This is for global equities.
Yeah, for global equities, for global equities. Broadly, if you look at the equities across the board, whether it's emerging market, Asia Pac, developed market, there's some correction. There's an opportunity to accumulate, but it's always be prudent when you're developing. If you're starting to develop your portfolio now or rebalancing your portfolio now, you can't go wrong if you have exposure to developed market. You can't. And if you're Malaysian investors, you should put some in Malaysia, particularly those portfolio that have exposure to our blue chips, because they are currently trading at a very good discount. Even some of the oil and gas companies look very, very attractive, valuation-wise. Remain diversified, but just for 2016, but for long-term, no harm if you increase your exposure to emerging market as well, given the attractive valuations.